Now that we've finished all the core concepts, it's time to move on to the next section, which is the market maker models, and we'll start off with time frame alignment. Time frame alignment for market maker models, and what do they look like? One of the keys to finding clean market maker models is understanding the time frames they form on in relation to the time frame of the PD array. So time frames are directly linked to each other, and if you stick to the rules I give you today, you'll have a lot more success in identifying them. So as always, time frame alignment for market maker models. We're going from a monthly PD array into a daily market maker model. We go from a weekly PD array into a 4-hour market maker model, a daily PD array into a 1-hour market maker model, a 4-hour PD array into a 15-minute market maker model, then we have a 1-hour PD array into the 5-minute, and then eventually 15-minute PD array into a 1-minute market maker model. Now, from monthly all the way down to the 15-minute, you can already see these are different types of personalities, right? We have the swing traders over here with the higher time frame, and then the hyper scalpers on the M15 and the 1-minute market maker models. So price is fractal, it just depends on how long are you willing to hold the trade. We've got this nice schematic over here, right? Higher time frame, we got that monthly level. We've got a weekly level or a daily level. Pick one, right? Which is most preferred for you. Scalpers most of the time want to have a daily level, right? 1-hour structure and PD arrays on the market maker model. Go to the 5-minute buy or sell program and market maker model entries. So same for a higher time frame on the monthly, right? We look at the daily structure, PD arrays for the market maker model, and then on the 1-hour, a buy or a sell program with market maker model entries. Time frame alignment for market maker models. So in a market maker buy model, there is almost always at least 2 stages of accumulation on the sell side of the curve, and in a market maker sell model, there's almost always at least 2 stages of accumulation on the buy side of the curve. The curve is defined by the lowest low in a market maker buy model and the highest high in a market maker sell model. So we've got this schematic for a market maker buy model over here. A market maker model always starts off with a original consolidation. So this is easily depicted by obviously a consolidation, then price expanding lower into another accumulation phase, right? So accumulation phase number 1. Think about market cycles too, right? Consolidation, expansion, consolidation, expansion, another accumulation phase, and then we hit that discount array, and there is the moment where we can anticipate a smart money reversal. Not earlier, we need to hit a key level. If you want to see a market maker buy model, we need to hit a discount array. So we've got this sell side of the curve over here, having our highest high up here and our lowest low down here, and then once we break structure upwards, after hitting that key level, right, we can go into buy side of the curve. Now same for a market maker sell model. Think about the original consolidation which needs to be present in a market maker model. We've got this consolidation down here, expansion again, right? Accumulation phase number 1, another expansion, accumulation phase number 2, another expansion, and then we need to hit a key level inside this premium array, right? And then we have this highest high, confirming sell side of the curve after we break structure and hitting that key level, and then we can start to look for sell opportunities and then completing this market maker sell model, liquidating this original consolidation. All right, so we've got a Australian US dollar monthly chart, and again, keep thinking about the core concepts, right? External to internal range with order pairing. So we've hit that external range liquidity. So what is the drawn liquidity afterwards? We want to go to an internal range, right? So external to internal. What does that look like on a daily time frame, right? Think about the time frame alignments. Can't stress this enough. If we look at the monthly chart, we look at the daily structure. If we look at the weekly chart, we look at the 4-hour structure, etc., etc., right? So On a daily time frame, we can see this original consolidation starting down here. Sell stops below it, obviously, right? Market expands higher, forming accumulation phase number 1, expanding higher again, accumulation phase number 2, and then eventually we keep going until we hit that premium level, right? So over here, that monthly external range liquidity, right? Now we've taken external range liquidity, and what happened up above this old high? Order pairing, right? For smart money shorts. So smart money pushes price down. We've got this break of structure down here, right? Then respecting this fair value gap, and accumulation phase number 1 over here on the sell side of the curve is happening. So we can anticipate lower prices and continuation into sell side of the curve, completing this market maker sell model until we reach that drawn liquidity, which is the monthly internal range liquidity fair value gap. Now on a weekly chart, New Zealand dollar versus the US dollar, again, we've got this time internal range into external range, right? So once we hit that internal range, we want to go and seek external range liquidity. That happens over here from this range high premium levels, right? So this fair value gap internal range makes sense to be a good point where we can reverse from, and then external range liquidity on the low side of this range. Now from a weekly, remember we go to a 4-hour structure. So earlier we had a monthly chart into a daily structure. Now we're going into from a weekly key level into a 4-hour structure. So we're starting off again, original consolidation, right? Sell stops resting below there, external range liquidity, accumulation phase number 1, accumulation phase number 2, expanding up higher into that internal range on a weekly time frame, right? And then over here we break structure lower. Does it make sense that we break lower from here? Yes. Why? Because we hit that internal range liquidity fair value gap on a weekly time frame, right? So now we're going into sell side of the curve, and you can see every premium array is being respected, right? We've got these fair value gaps being respected, pushing down lower, and you can see, think about high resistance and low resistance liquidity runs, right? What do we have down here? Failure swings, failure swing, right? So sell stops are resting below here. Price action wants to keep continuing down, and also think about high resistance liquidity runs, right? We see a rate on this high, for example, or a rate on this high, or a rate on this high, and you see immediate rejection lower, confirming sell side of the curve until we hit that external range liquidity, completing that market maker buy model. So we got E-mini Nasdaq 100 futures chart over here. Again, we think about external to internal, right? So we have daily low sell stops being rated, turtle soup, right? Now we want to go into an imbalance or a lower time frame market maker buy model. So this is a daily time frame, right? Think about we went from monthly to daily structure, weekly to 4-hour structure, and now we're going from a daily PD array into a 1-hour structure. As always, we start off with an original consolidation, right? Always outline your original consolidation and where your market maker buy model draw on liquidity should be, right? From here, we go from external range liquidity, right? Sell stops have been liquidated. Accumulation phase number 1 has happened over here. Accumulation phase number 2 happened over here. And then we form that smart money reversal down here below an old low, right? Sell stops have been liquidated. Again, what happens down here? Order pairing, right? Smart money longs are being accumulated down here, then push price up higher, and buy side of the curve is being confirmed after break of structure, and we're disrespecting a bearish fair value gap, right? Should not happen if we are bearish, so continuing up, respecting bullish fair value gaps, and buy side of the curve has been confirmed until we liquidate this original consolidation up here. Diving one time frame lower, again 4-hour chart, so 4-hour PD arrays, and then we're gonna dive in a 15-minute chart, right? And we keep going down and down inside the time frames, and it is all fractal, right? It works on a monthly to a daily structure, it works from a 4-hour to a 15-minute, and so on. So from this range low, right, to this range high, this is our dealing range. Everything below this 50% level is discount. Now, again, we think about external to internal, internal to external, order pairing, very important, right? So we have an external rate over here, or a turtle soup, right? Now, what are we going to be looking for our next draw on liquidity after we take out external? We're going to look for an imbalance in discount, preferably, as our draw on liquidity, which is this fair value gap, right? This fair value gap is also a draw on liquidity, but it's still in premium, right? Because this above this 50% level, this is still premium, so we can dive a little bit deeper down inside this discount level. And how does that look like on the 15-minute, right? Market maker buy models, market maker sell models. It is all fractal. So 4-hour PDRA above an old high external range liquidity. Original consolidation down here, leaving some low resistance liquidity, right? So we know sell stops are resting below here, and that drawn liquidity was way lower, right? The daily or that 4-hour fair value gap in discount. We had accumulation phase 1 happening over here, accumulation phase 2, and then eventually smart money reversal above buy stops, right? Order pairing again, continuing down lower, 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 completing this market maker sell model on a 15-minute time frame. We're diving one more time frame lower, right? 1-hour chart. So we're getting into scalper territory right now. So 1-hour time frame, we can use a 5-minute market maker model. I think most people prefer a 5-minute market maker buy model, so you can have an intraday trade, right? If you're trading off a weekly key level, for instance, you're gonna hold your trades for a few days probably. So 1 hour is for most people, I think, the way to go, depending on your personality, of course. Now, again, we think about external to internal, right? We see these buy stops getting rated over here, over here. So we have external rate. We want to go to internal range liquidity, which is this 1-hour fair value gap, right? And once we hit that internal range fair value gap, we can look for external again. And then we dive into a lower time frame, which is the 5-minute time frame, right? And see if we can spot a market maker buy model forming. Also think about low resistance liquidity, right? Failure swing up here, engineered liquidity. So let's dive into 5-minute time frame. So we got this pretty clear consolidation, right? And inside this consolidation, we can also see a failure swing, right? This high and this high, failure swing, this high to this high, failure swing. And then accumulation phase 1 happens, accumulation phase 2, and then eventually we hit that key level, right? We always want to trade off a key level. So 1-hour fair value gap down here, smart money reversal, and you can actually see this long wick down here rates all this sell stops down here. Again, order pairing, right? External range liquidity. Now we're breaking up structure higher, and we keep respecting this fair value gap, and eventually it pushes up in one accumulation phase, right? So we have that expansion, accumulation phase 1, and then another expansion, completing this 5-minute market maker buy model. Now we dive into the lowest possible time frame for this market maker model. I guess if you want to be really freaky, you can go to a 5-minute time frame and go on a 50-second chart, but I would highly not recommend doing that. And this would be your lowest time frame for a market maker model setup. So 15-minute time frame, again, buy stops have been rated, right? So external range liquidity, and then we're gonna look into a 1-minute time frame. And personally, I think if you do like a 15-minute time frame as your key level and then 1-minute market maker buy or sell model, a pair like GBP JPY is perfect because these pairs move a lot compared to, for instance, Euro USD. Right, so this 15-minute high, right? Remember, buy stops have been rated with this clear this clear original consolidation. Now, after that original consolidation down here, we've got accumulation phase 1 and accumulation phase 2 until we clear those buy stops, right? So key level has been hit, smart money reversal is in, and then we break down here, respecting this bearish fair value gap, and then continuing lower. Again, think about high resistance liquidity runs, right? We see this high getting rated over here, and then you see that immediate drop lower, indicating you're still on the sell side of the curve. And then this should be the draw on liquidity and completing this short-term market maker sell model on the 1 minute time frame. So now that we went over time frame alignment, let's move on to mitigation blocks. So what is a mitigation block? Mitigation blocks are the bullish order blocks on the buy side of the curve in a market maker sell model, and the bearish order blocks on the sell side of the curve in a market maker buy model. So where smart money bought in those bullish order blocks, right? We're gonna use that same order block on the sell side of the curve to offload their orders and mitigate their positions. Right, we've got a Australian dollar, US dollar daily chart, and we see a clear market maker sell model forming over here with this original consolidation, right? Accumulation phase number 1, accumulation phase number 2, and eventually taking out external range liquidity and making the highest high in this curve. So after we break structure, we know we are going to go into sell side of the curve, highly likely, because we took out external range again, right? So we're expecting this bearish PD array. Now, where are the order blocks on the buy side of the curve? Those down close candles, right? Before my price moves up. So we're going to outline those bullish order blocks to the sell side of the curve. So we want to extend the bullish order blocks from the buy side of the curve into the sell side of the curve, because that's where smart money bought before, and now they will use that to sell. We want to pair the mitigation block up with a new sell side PD array. So as we just saw, a bearish fair value gap, we want the sell side PD array to be inside the zone of the mitigation block, and we'll outline in the chart how that looks like. So over here we outlined all those order blocks, right? The bullish order blocks on the buy side of the curve. Now we're heading into sell side of the curve, and we're going to outline this bullish order block to the sell side of the curve, right? So we want to see our new sell side array form around this area where we can use this as a mitigation block. So we can see this fair value gap here, right? We displaced lower and breaking structure. So this is a premium array which we can use to sell off from. So outlining this bullish order block to the sell side of the curve, right? Now we can see where we can mitigate our orders. So filling up this fair value gap, not quite fully, but we tapped over the 50% level and then we reject. So in the process, we're creating this bearish order block over here, right? And it's co-inlined with this bullish order block from the buy side of the curve. So now we have this layered, right? So now it's high probability this area can be used to mitigate their orders. So this mitigation block coupled up with a bearish order block, and then we can find an entry on over here. Price keeps continuing down until we reach that internal range liquidity, right? Again, from external to internal, and then sell side of the curve with those mitigation blocks. We have another one over here and another one over here, which we can outline too. So we outline this bullish order block from the buy side of the curve into sell side of the curve, and again, we are forming a bearish order block inside that old bullish order block, right? So we have old accumulation over here for buy orders, and now we have a new distribution for shorts to mitigate smart money positions. And lastly, this bullish order block extended out in time. We are forming what a new array, premium array over here, right? This fair value gap. Inside this old accumulation did this bullish order block, and makes it even higher probable this will hold and we can continue down for that last push and completing that market maker sell model down here. Right, we've got a British pound Canadian dollar daily chart. We filled up a monthly fair value gap right here. Took out these daily sell stops down here, so we went from external to internal. What does that look like on the 1 hour chart? So with the start of a market maker buy model, we need an original consolidation, right? Over here, we've got that original consolidation. Accumulation phases down here until we reach that higher time frame key level. Smart money reversal down here. And now we're going to use those bearish order blocks on the buy side of the curve, right? To mitigate those positions. So we have mitigation blocks for the buy side of the curve. So outlining this bearish order block down here, extend it out in time, and you can see a PD array has been formed over here inside, which is a fair value gap, right? So you really want to see those new arrays form inside that old accumulation over here. So bearish order block being used to co-inline with this fair value gap, and hence you can send the price higher. Again, over here, another bearish order block extended out in time. And then what happens inside this area? We form another fair value gap, right? So we have another array which is formed inside that bearish order block, creating a mitigation block for their smart money positions. So here they were in sells, right? And now they can convert their sells into longs in that same area. And lastly, up here we have another one, right? Extend it out in time. We've got another mitigation block up here, right? A fair value gap has been formed over here, and then continuation to complete this whole market maker buy model. So really outline those old arrays from the sell side of the curve, extend them out in time into the buy side of the curve, and wait for your new PD array to form, and then it will be higher probable to take a trade from. Now let's move on to how to trade those market maker models. Before we do that, let's remind ourselves of the time frame alignment, right? Those PD arrays on the different time frames. So from a monthly array into a daily market maker model, from a weekly array into a 4-hour market maker model, daily array to a 1-hour market maker model, and so on and so on. So price is fractal, right? So we can scout for setups using different arrays and different market maker models. Right, so over here we got a crude depiction of how it looks like on a chart, right? We outline our premium to discount levels and scout out where the original consolidation has formed, right? We've got on the lower end of this discount, we've got that original consolidation, hourly structure, right? Moving up, accumulation phase number 1, let me repeat that. So we've got this original consolidation down in discount over here. So we know this is going into buy side of the curve. Hourly structure on a market maker sell model. We've got that accumulation phase number 1, accumulation phase number 2, until we hit that daily premium array, right? We're going from a daily into a 1-hour market maker model. So price goes up into the daily premium array. We wait for that 1-hour stop hunt, and from here on out we can scout for an opportunity into a market maker sell model. In this piece of price action down here, we can see this is a bigger market maker sell model, but price is fractal, right? So on this 1-hour stop hunt, we can see a 5 minutes, on a 5-minute structure, we can see a 5-minute market maker sell model form. And this is our opportunity to get in on a trade. So a sell program up here is activated. Up close candle should support price lower, and bearish PD array should be respected, right? Going into sell side of the curve and then eventually liquidating this original consolidation. Now how does that look like on a candlestick chart? We've got E-mini S&P 500 futures over here, daily chart, right? So remember, we're going from daily PD arrays and daily external range to internal range into a 1-hour structure and looking for our market maker models over there. So over here we got these buy stops run, right? Let's go to a 1-hour time frame. Over here we got that run on stops on the buy side liquidity on the daily chart, right? Now we identify on the 1-hour where is the original consolidation, right? Down here we've got this nice original consolidation. Price expands up higher, 2 accumulation phases, and then eventually liquidating that high. And now we can scout for a market maker sell model, right? And all up close candles, which are bearish order blocks, should be respected on the way down, and also those bearish arrays, right, like fair value gaps. Zooming in a little bit more, we've got that accumulation phase 1, accumulation phase 2, and then external range liquidity up here has been taken, right? So break in market structure over here, and then price retraces back up, and this is an opportunity to look for a market maker sell model. We've got that breakaway gap up here, and remember from core concepts, right, we've got that new PD array, that redelivered, rebalanced gap over here. Price has no business going into that breakaway gap, and it should form a sell side of the curve down here. If you go to the 5-minute time frame, we can see a market maker sell model form here, so we can zoom in a little bit more. Right over here, we've got that 5-minute time frame, right? Remember, we're going from a daily external range liquidity rate into 1 hour structure, and eventually once we hit sell side of the curve on the 1 hour, we can scout for a 1 hour PD array, which in this case is that redelivered rebalance gap, right? And then on the 5-minute time frame, we can scale in down even more and look for a more precise entry. So over here we got that original consolidation with sell side liquidity, right? Also equal lows. So very nice target for sell side. Accumulation phase 1, accumulation phase 2, buy side of the curve. Once we hit that PD array up here, then we can go into sell side of the curve, and now every up close candle should resist price to go lower. Always match up your entry with the correct kill zones, right? London kill zone 2 a.m. to 5 a.m. or New York kill zone or London close kill zone. And if you trade indices, go with AM session and PM session, right? So in the correct kill zone, so time is in your favor, and we can see that over here it hits it in the kill zone, that higher time frame PD array, and from here on out we should see bearish arrays being respected. So sell side of the curve, right? Again, use those mitigation blocks, right, from the previous lesson. We've got this bullish order block over here. We can extend it out in time to the sell side of the curve. Now, is there a PD array formed inside this mitigation block? Yes, we do have a volume imbalance over here, right? And then a bearish order block being formed also. So this is a nice area to take a short from. It's lining up with that mitigation block from the buy side of the curve into sell side of the curve. And eventually we've got the same thing happening over here, right? That bearish candle over here is a bullish order block. It's being traded in through. Now it's becoming a breaker block, right? Because a breaker block is structure liquidated to the upside and then breaking structure lower. Then we have a bearish breaker block, which you can extend out in time. And over here, you can see it hits it and then continues to liquidate this low. So market maker sell model completed all the way from the daily, right? External range again, going into a 1 hour structure. You look for that PD array on the sell side of the curve on the 1 hour and zoom in even more on the 5-minute to find that fractal market maker sell model. Right over here we've got US dollar Swiss franc weekly chart. Take a look at this chart and where are we most likely to draw into. So at first we take external range liquidity, right? So now where does your attention go into for your drawn liquidity? Right over here, we've got this area, redelivered, rebalanced. Little tiny fair value gap, so the drawn liquidity is from external to internal, and we're zooming in on a 4-hour chart. Now, with this being messy, if we drop down into the lower time frames and scout our structure, we can still manage to navigate through all this consolidation on the 4-hour, right? So we know external range has been taken on the higher time frame, also on the 4-hour. Remember, this order pairing happened down over here below an old low. We know we go from external to internal, right? The drawn liquidity is up here. Where's the original consolidation? It's up here. So we've got a market maker buy model forming. Now we need to take external range and have a smart money reversal, which is down here, right? Market structure shift up here, breaking structure after liquidating the lows, very important. We need to take external range and then drawn liquidity on that original consolidation with internal range on the daily time frame. 4-hour fair value gap is being respected. Candles are respecting the CE of this fair value gap, so the 50% level, right? And then this retracement is a market maker buy model on a 15-minute time frame. So now we're on a 4-hour, right? We went from a daily external range and now our drawn liquidity is the internal range. We can see this market maker buy model form on a 4-hour and break of structure and a higher time frame POI. So let's zoom into the 15-minute. Right, we're on a 15-minute chart, right? We have another original consolidation inside this 4-hour structure, right? So think about it. Price is fractal, so this happens on all time frames. You can even dive into a 1 minute after this one and find a market maker buy model or a short-term market maker sell model even. So down here we got this consolidation, accumulation phase 1 and 2. This retracement is a market maker buy model, right? We liquidate this low again, short-term order pairing over here for those sell stops. Break of structure up here. What are we leaving up here? Right? Engineered liquidity. Price drops down back into that 15-minute order block. 15-minute fair value gap. Right? And then draw out your premium and discount level from this low. We liquidate this low, dealing range low. We take out this buy side liquidity. That high over here is our dealing range high. So we have our premium levels and our discount levels. Then this fair value gap is a discount array, and you can see price liquidates this one. And again, this is a high resistance liquidity run, right? Because we just take out this low and then reject immediately. So order flow is bullish. And then we've got another breakaway gap. Why? Because we have that PD array, right? That redelivered, rebalanced PD array, which is a balanced price range. So we have two opportunities to get in on this market maker buy model, and let's see how that looks like with the New York Midnight Open price. So on this day, this is a Monday. If you extend this New York Midnight price over here all the way in time, you can see London session highly likely to create low of the day, right? So dropping below New York Midnight opening price, we know after we create low of the day, we want to see displacement and a fair value gap or an order block being formed where we can base our trade off. So this was a good first entry to take because the drawn liquidity is still up in this original consolidation, right? So until we liquidate this original consolidation, we can still find entries multiple times. So over here, first entry was possible. On a Tuesday, there was another entry possible, right? Draw out your midnight opening price, 12 a.m. EST, and then that redelivered, rebalanced PD array is over here, creating this breakaway gap, and then drawn liquidity was still not reached, right? Remember, and on a 4-hour time frame, that original consolidation is even higher. So the potential to go higher and higher on this chart is very likely, and we can see we just use those discount arrays, and then second opportunity on a Tuesday arrives, and then eventually liquidates that market maker buy model. So how to trade the 1-minute chart and 1-minute market maker models. The 1-minute chart is based off the 15-minute structure and PD arrays, right? So remember about time frame alignments from monthly to daily structure and so on and so on. And now we go from that 15-minute PD array into a 1-minute market maker model. Right, so we got USD Swiss franc again, right? Same chart. And now we can dive into even a lower time frame to scout where we can get in. And we know this is a 15-minute market maker buy model, right? But from here to here, this retracement is a form of a market maker buy model, right? Because we're hitting a higher time frame PD array, and the higher time frame in this case is a 15-minute time frame. It's all fractal, so if we dive into the 1 minute, then the 15-minute is a higher time frame, right? If we go and dive into in a 1-hour chart, that's the higher time frame for a 15-minute market maker buy model, and so on. So again, this retracement down here, that will be a 1-minute market maker buy model, right? We're dropping below New York Midnight Open price, so everything is lining up. Higher time frame is lining up, and now we dive into the 1 minute to scout for our setup. Right, so buy side liquidity above here, right? Market maker buy model, original consolidation. This is that retracement on the 15-minute, right? And then we got that 15-minute fair value gap, which is the higher time frame PD array to take our trades from. So going into sell side of the curve here, right? Smart money reversal, respecting this little fair value gap, right? Continuing buy side of the curve until we complete this market maker buy model on the 1-minute time frame. Outlining those phases, right? Original consolidation, accumulation phase 1, accumulation phase 2, and then eventually smart money reversal is down here. Smart money reversal needs to happen in a higher time frame PD array. It cannot happen anywhere. So if you think this is like a smart money reversal, but we didn't hit any higher time frame PD array yet, right? The CE is down here, and then actually we're leaving out these engineered liquidity up here, which is a failure swing, unequal highs. It's perfect draw liquidity for buy side of the curve. Market structure shift over here, also one down here, but this is a significant break in structure. So where do we get in? We've got this breaker block, right? This mitigation block over here. Now, do we form a PD array on this breaker block? Yes, we do have that bullish order block up here, right? And then price finds support up here and continue up higher. Again, outlining those mitigation blocks. Remember, right? Those bearish order blocks, extend them out in time. Now we've got that mitigation block for a new fresh PD array for the buy side of the curve. So we create another fair value gap, this displacement up here, co-inlined with that mitigation block, making it high probable it will hold, and then completing the market maker buy model over here. And what is most important too, time, right? So be in a kill zone to look for your setup. So New York kill zone starts over here, 7 a.m., right? And this part is in the kill zone. So we form that smart money reversal just before the kill zone, and we want to look for entries inside the kill zone. Right, so we got a higher time frame chart over here, Euro USD. We start off with the monthly. We've got that internal range liquidity, right? Higher time frame PY. So remember, time frame alignment, monthly chart, PD arrays into the daily structure, right? So let's go to the daily. So on the daily, we hit that monthly fair value gap, right? We have a market structure shift down here. So we're going into sell side of the curve. So now we know bearish order flow on the daily time frame. It makes sense because we got that time frame alignment, right? We have that higher time frame PY in the monthly fair value gap. So it makes sense for the daily structure to shift. Where is our opportunity? We've got this sell side liquidity down here, and we form a displacement in the form of a fair value gap here. So opportunities lie inside this fair value gap to go down into this sell side liquidity. So if we use that daily PD array, what kind of structure do we need to use? Right, 1 hour structure, right? So from this high until this low, we can find our potential market maker sell model forming, and the daily order flow is in line with this idea. And the market maker sell model on the 1 hour is completed once we liquidate this low and eventually take out this one on the daily time frame. So diving into that 1 hour time frame, remember we've got that daily fair value gap right up here. So before we want to go into sell side of the curve, we need to hit this higher time frame PD array. Original consolidation down here, right? Accumulation phase 1 and 2, and then hitting that key level, making a smart money reversal. So over here, this is important. We need a key level to key off and go into sell side of the curve from there, and then we can dive in even deeper in the 5-minute chart later to find a more precise entry. But over here, how to trade this 1 hour time frame? What do we form, right? We take out buy side liquidity up here and then start to break structure lower. So this bearish candle becomes a breaker, right? So and then in this breaker, there's your opportunity to go into a sell. We know we don't have to go up here anymore. We know sell side of the curve is confirmed, and we should not disrespect bearish arrays anymore. And then continuation until we liquidate this one. So this whole row of up close candles is a bearish order block, right? So price should offer support to go lower. Same case over here. All these up close candles over here is all a bearish order block, and you can see price drops below it, goes back one more time to go into that bearish order block, and then finish off that market maker sell model on the 1 hour. Now we can dive into a 5-minute time frame too. So on the 1 hour you could have gotten in with a breaker, right? So entry on the breaker, stop loss above the breaker, and then continuation lower. But if you dive into the 5-minute time frame, we have this piece of price action over here, which could be a market maker sell model being formed, right? Because we take this external range up here, and then we have that fair value gap being fully filled in. So that makes sense to continue down lower. So if we dive into the 5-minute time frame, so we're going all the way from the monthly, right, into daily structure, and we know our daily structure was bearish. We had that fair value gap where we could base our trade off from on the 1 hour chart, and now we dive even deeper down in the 5-minute chart, to go and find a market maker sell model. So again, every time we need to scout this market maker sell model original consolidation, right? So original consolidation is down here. Sell side liquidity is resting below this, and see all these failure swings, right? So we have engineered liquidity around this area. Price moves up and up and up, leaves engineered liquidity behind once again, drops back down, and retracement to continue up and fill up this whole 1 hour fair value gap and taking out all this engineered liquidity up here, all these buy stops. So from here on out, it's a high probability key level where we can go into sell side of the curve, and all up close candles should support price to trade down lower, right? So we have this bearish order block here, price drops, displaces too, so making it even higher probable after this break of structure that this bearish order block will hold. Again, with these two up close candles, they keep supporting price to turn down lower. And then over here, another array has been formed, right? This bearish fair value gap, continuing down lower, little consolidation and expansion, and then finally completing that 5-minute market maker sell model. Coming up into the last lesson of the market maker model section, we're going to be talking about the silver bullet. The silver bullet. What is the silver bullet? It's advanced market structure, and we'll show you in some charts later how that looks like. But first, what is a silver bullet? The silver bullet is the second stage of accumulation in a market maker buy model, or it is the second stage of distribution in a market maker sell model. And the hardest part for most traders is being able to identify the stages in the moment as price is printing live. So how do you know that this next leg is the silver bullet, and why is the previous high or low the low risk sell or the low risk buy in that market maker model, or as we call it, stage 1? We do not need to know the low risk buy or the low risk sell in the moment as price is printing. We know when the silver bullet is going to be forming by understanding intermediate term highs and intermediate term lows. This is all about market structure. An intermediate term high is a high that has a short term high to the left of it and to the right of it. And an intermediate term low is a low that has a short term low to the left of it and a short term low to the right of it. So the intermediate term high or the intermediate term low is where you place your stop loss. That's the high or low in the structure you don't want to see get violated. There are two ways to trade the silver bullet. Trading after a confirmed intermediate term high or intermediate term low has formed, so it has a short term high or low to the left and a short term high or low to the right of it, or we're going to anticipate that intermediate term high forming and trading that short term high or short term low that will be forming next to it. So over here we got a crude depiction of how a market maker model looks like. We got that again original consolidation up here, right? And then hitting a key level once again where the smart money reversal should occur. Now breaking structure up here, and then the first area over here, that is the low risk buy in a market maker buy model. We're not looking for this, we're looking for that second stage of accumulation in this market maker buy model. So looking at all the lows and highs being formed around in this area, we can see this is a long-term low. Now why is this a long-term low? It's the extreme low in this whole range, and it has a short-term low to the left of it and a short-term low to the right of it. So this is a short-term low. Now once we start to break up further, there will be more short-term lows being formed in that whole range moving up, and we are waiting for that short-term low after the low risk buy to get rated, and then we form that intermediate term low. So we expect price not to exceed this intermediate term low once again. We call that a protected low. So in anticipation of that intermediate term low forming, we can see the second stage of distribution forms after we form that intermediate term low. So essentially you're going from this external range liquidity, right, this short-term low getting rated into another price leg up, and inside this another price leg up we anticipate a short-term low forming, which is the silver bullet, right? So this is an entry model for second stage of the distribution or accumulation phase. Referring back to the other lessons, right, mitigation blocks, we can use all those techniques to solidify our trade idea where that short-term low should form. We've got that mitigation block on the sell side of the curve. extending it out in time, right, to the buy side of the curve, we see this intermediate term low forming, and it is only an intermediate term low once we form a short-term low to the right of it, right? So we need to have a short-term low to the left of it and then a short-term low to the right of it. And this is the silver bullet entry model and second stage of accumulation. So this is option number one, anticipating that short-term low to form next to that intermediate term low. So this is option number two, right? And this is, we're waiting for that intermediate term low to be confirmed. So we need to see that short-term low to the left of it and that short-term low to the right of it, and then we have a confirmed low. So over here, same sort of depiction, only slightly different market structure, right? We've got these equal highs getting rated, but we also have these equal lows down here, which are short-term lows, and we're expecting that intermediate term low to form below this short-term lows after that smart money reversal. And remember that smart money reversal needs to happen in a discount array. Sell side of the curve, smart money reversal, and forming that long-term low, right? Because this is the extreme low in this whole range. Short-term low to the left, short-term low to the right, and that intermediate term low forming will be inside OTE levels of this range, right? So intermediate term low has been confirmed after we form another short-term low to the right of it, right? So then this is accumulation phase one, because this is now the low risk buy. And in the previous schematic we saw price action drop into this area over here, creating the low risk buy already and then continuing up, and then we wait for that intermediate term low, right? But over here, that low risk buy is in fact that intermediate term low. So remember, you need to have a short term low to the left of it and a short term low to the right of it. Accumulation phase number one happens over here, then we expand higher again, and then the silver bullet is forming, which is the second stage of accumulation. Again, thinking back about order pairing, thinking back about mitigation blocks and that kind of techniques, right? We can use that mitigation block once again. So this could be a bearish order block, right? We violate that bearish order block, and once price trades back into it, we can use it as a mitigation block to offload those short positions and go into long positions from smart money and completing that market maker buy model above that original consolidation. Now for a sell model, same thing, only inversed, right? We've got that original consolidation to the bottom over here, going into buy side of the curve, and we need to hit a key level, right? So smart money reversal over here, dropping below this market structure low, creating a break of structure, low risk sell occurs over here, and then we go into the first distribution phase. Now we need to see an intermediate term high form, right? Because we're on sell side of the curve. So what do we need to have? We need a short-term high to the left of it and a short-term high to the right of it. Right? So low risk sell, short-term high, another short-term high is formed, and then that intermediate term high is being formed. We could have a bearish order block inside this price leg up over here, and that makes sense that this high will hold, right? And this is option number one, right? We anticipate this short-term high forming over here. So our entry is in anticipation of that short-term high forming to the right of it, right? Looking at it from a different perspective, option number two, again, we drop lower, breaking structure after that smart money reversal, right? Short-term high to the left, long-term high, and then another short-term high to the right of it. Now we need to wait for that intermediate term high to be formed. We wait for a rate on liquidity of those short-term highs, which happens over here, right? So now we wait for a short-term high to get created to the right side of it. So we have one on the left side and one on the right side, creating this intermediate term high, and then distribution phase one happens, and then breaking down lower, and here is where the silver bullet forms, right? Again, think about those mitigation blocks, right? There could be a bullish order block over here, which is violated, and then price trades back into that, creating that mitigation block to offload those long positions from smart money into sell positions and creating a down move which will liquidate that original consolidation. Here another schematic, and then that mitigation block happening a little bit earlier, right? So you have multiple areas of mitigation blocks, right? We use those bullish order blocks on the buy side of the curve and extend them out to the sell side of the curve. So over here we've got that intermediate term high forming around that mitigation block, and once it breaks lower, that short-term high forms inside that mitigation block, making it a very high probable silver bullet setup. So the second stage won't form this way every single time. However, the majority of the time it will. So if you stick to this rule, you will see a lot of success in identifying and trading it. When you see this structure form at the highs when bearish or at the lows when bullish at a key level, importantly, and you are using time frame alignment, it's very, very likely that the market is and has turned and is looking for the opposing liquidity or discount and premium levels. Right, so we got a Australian dollar, US dollar daily chart, right? Again, keep in mind every time, right? External range liquidity into internal range liquidity. We rate this external range liquidity old daily high. Where does your eye go to, right? We have an imbalance down here. So our draw on liquidity is down here. So now we know this high over here is unlikely to get traded into again, and our next draw on liquidity is to fill up an imbalance or reprice into a fair value gap, right? Because the algorithm only does two things, which is running old highs and lows, right? And repricing into imbalances and inefficiencies. Now we see this big daily candle completely filling up this fair value gap on the daily time frame. Now we drop down into a 1 hour chart, right? How are we going to identify where to get in, right? We wait for that intermediate term high to form, right? And then we look for that silver bullet setup. So look at this chart for a bit and see if you can spot the silver bullet. Right, now let's look at market structure, right? What do we need? We need a long-term high above an old high, right? We need that smart money reversal. So we have a short-term high here, long-term high here, short-term high here, right? And now we wait for that intermediate term high to be formed. So how does that look like? Right, smart money reversal above that old high, breaking down lower. And what do we have down here, right? Low resistance liquidity or engineered liquidity. So our drawn liquidity gets better every time when they engineer liquidity on the sell side. Price trades back up into OTE levels or premium level of this range, right? Creating that low risk sell, forming another distribution phase, dropping lower, and then the silver bullet is the second stage of distribution and it forms over here. Now let's look at the different highs, right? We have a short-term high here, long-term high here, short-term high to the right of it. Now we need to wait for that intermediate term high, which is forming above over here, right? And now we need a short-term high to the right of it, which is over here. And this is what it looks like, that intermediate term high, which is also the low risk sell in this occasion, right? So we don't get in over here because we waiting for that short-term high to be formed, right? Which is over here, and then price drops down lower, and now the silver bullet is activated in the second stage of distribution. Now we're looking for a mitigation block, right? Or a breaker block. We use those bullish order blocks from the buy side of the curve and extend them out in time, right? And use them on the sell side of the curve. And we can see over here we got this breaker and mitigation block, which is being tapped into. You could use this one. You could use the wick of this one too. This is overlapping and it's high probable that the silver bullet will form over here, which is another short-term high, right? Continuing down and filling up that daily fair value gap, which is the draw on liquidity. So we got gold futures chart over here. Again, external into internal, right? Keep that in mind, order pairing. We've got these buy stops being liquidated up here. Bearish order blocks being respected. Another one over here. Now let's look at market structure. Diving into that 3-minute time frame, right? So we're going into time frame alignment. This time we used a 30-minute order block and we're going into a 3-minute time frame to see if we can spot that silver bullet setup. So we have this market maker sell model formed over here. Sell side liquidity over here. We know the draw is bearish. Price keeps going up and up and up until we go into that higher time frame POI, which is that 30-minute order block, right? Market structure shift to the downside over here, and now we need to wait for that intermediate term high to form, and this time we're going to anticipate a short-term high forming next to it, and that will be our silver bullet, right? Smart money reversal again in a logical key level, breaking down structure, distribution phase number 1, breaking down further, and then the silver bullet will form. Annotating market structure, short-term high to the left of it, and in that smart money reversal we got that long-term high, right? So short-term high to the left and a short-term high to the left of it. Then we have that long-term high and then a short-term high to the right of it, which is in this occasion the low risk sell. Now we're breaking down structure, confirming sell side of the curve, right? Then forming distribution phases over here. Outlining some more structure, right? We have this swing high over here. Now we wait for this swing high to get rated and dropping down further and anticipating this to be an intermediate term high. So immediately our stop loss could be above here once we look for that second stage of distribution, right? That silver bullet setup. Price drops down lower, lower, lower. Sell side liquidity is still intact, right? So our drawn liquidity is still present. We wait for price to go back into a PD array, which in this case is a fair value gap over here, right? It's going into a premium level from this range high to this range low, so that makes sense. And the silver bullet is being formed over here. Outlining that mitigation block over here, right? We use those bullish order blocks on the buy side of the curve, extend them out to the sell side of the curve. Is there a fresh PD array formed over here? Yes, there is, right? We've got this fair value gap and price dips into that fair value gap and declines, completing that sell side liquidity. Right, so we've got a crude oil 4-hour chart and we're going to be looking in anticipation of an intermediate term low forming in this market maker buy model, right? So what do we have over here? We've got a key level, right? A fair value gap in discount from this range high to this range low. We see we are respecting it and continuing up, leaving behind low resistance liquidity, right? So our eye should immediately go here for the drawn liquidity. Price retraces back into that 4-hour order block, and now we can use time frame alignment, right? 4-hour PD array into a 15-minute market maker buy model, and let's dive in a lower time frame to see what that looks like. So smart money reversal happens over here in that higher time frame POI, right? We've got that 4-hour order block. We've formed a market structure shift up here, low risk buy down here, and then the first stage of accumulation is happening in the next PD array, which is this fair value gap, continuing up, and then we're anticipating this to be the intermediate term low, right? Because the silver bullet is the second stage of accumulation, and now we're anticipating this low to be the intermediate term low. So our silver bullet setup will be a short-term low to the right of it, right? And we need to wait for it to decline into discount and use a fair value gap as an entry. So if I go over here, we can outline those short-term lows, long-term lows, and intermediate term lows in the next slide. But we've got that short-term low down here, right? On that smart money reversal, again, on a key level, important. Long-term low down here, because we have a short-term low to the left of it, and a short-term low to the right of it. Bullish order block, supporting price, pushing up, breaking market structure. This is called a low risk buy, right? For smart money. But for us, it's not a low risk buy because it's actually a little bit higher risk for us because we don't know if market structure shift will happen. That's why we wait for that market structure shift. And this whole silver bullet setup is a very solid entry model. We anticipate this low being formed, being the intermediate term low. Why? Because we take out this short term low, right? And then creating another short term low to the right of it. Now marking out your PD arrays, right? Mitigation blocks, breaker blocks, and then premium and discount levels. We've got that bearish order block over here, which is being used to the buy side of the curve, right? So now it's a mitigation block or a breaker block because we took sell side liquidity down here. Is there a PD array formed inside this mitigation or breaker block? Yes, there is, right? Because we have that order block up here. And then a fair value gap combination also. So we have a lot of confluences in this area to anticipate this being the intermediate term low, and the silver bullet setup will be the short term low to the right of it. And then you can see price is very willing to continue up higher and complete that market maker buy model. Right, so over here we've got an E-mini S&P 500 futures chart on a 30-minute. We've got these clean buy stops formed over here and sell stops have been rated, right? So we've had external range liquidity been taken. We're starting to move up into buy side of the curve. And now we're going to look at a confirmed intermediate term low, right? And we'll dive into the lower time frame for this. We've got this BPR over here, right? That PD array, that redelivered rebalance PD array. The price is rejecting off that. So again, going into buy side of the curve after hitting a key level, right? That key level over here was the 30-minute BPR or redelivered rebalance PD array. We're in a 3-minute chart right now, so we're doing time frame alignment once again, right? Higher time frame PD array into a lower time frame market maker model. So price is trading up higher right here, continuing up and then forming a short-term low here, and we see this getting rated. So what is this low? Low risk buy, right? But also we have an intermediate term low formed down here. Why? Because we have that short-term low to the left of it, right? And that short-term low to the right of it. Now this is confirmed, right? Instead of anticipating and taking an entry on this short-term low, now we wait for this intermediate term low to be formed and then go into second stage of distribution, which is over here, and that will be the silver bullet setup. So where do you get in? Again, we have that BPR, right? Just like that on the 30-minute time frame, that redelivered, rebalanced PD array. Same thing over here. We have that up, down, and then the next candle up, right? And then we can outline this gap over here, leaving a breakaway gap too over here, because we don't need to go into this fair value gap once there is a BPR formed above it, right? So we have this mitigation block on the left side, right, on the sell side of the curve, which would be a bearish breaker. That would be a bearish order block over here, right, extended out to the buy side of the curve. Now it's overlapping with a new PD array. So again, layering all those confluences, looking at market structure. Do we have an intermediate term low? Yes, we do, right? So ideally, you can take an entry here. If you're very conservative, you can put your stop loss below the intermediate term low, because that for sure should not get rated. But after we already did this entry in this short-term low, I think it would be solid to just have our stop loss below this fair value gap, which should be a breakaway gap anyway, and that would be a very good risk to reward trade. Silver bullet, short-term low.